Hello and welcome to Trading to Rise. Today we're going to break down a word you've probably heard a lot, one that sounds really complex but is actually built on a super simple idea. Derivatives. If that word has ever sounded a little intimidating, you're in the right place, because we're about to make it crystal clear.
So here's how we're going to do it. First, we'll cover what a derivative actually is. Then we'll look at the main types of contracts you'll see out there. After that, we'll meet the key people playing in this market, explore their two main strategies, and we'll wrap up by looking at both the promise and, well, the peril of these powerful financial tools.
So why should you even care about derivatives? Well, let's just start with this number. Over $558 trillion. That was the estimated size of just one part of the derivatives market, and that was back in 2019. To give you some perspective, the entire world's GDP that year was around $87 trillion. So, we're talking about a market that is more than 6 times bigger than the entire global economy. It is a financial force you simply cannot ignore.
All right, let's get right to it. The big question. What on earth is a derivative?
When you strip everything else away, a derivative is just a contract. It's an agreement between two people or two parties. But here's the absolute key. The contract itself doesn't have its own value. Its worth depends entirely on the price of something else. Actually, the name itself gives you the biggest clue. A derivative's value is derived from what we call an underlying asset. Now, this underlying asset can be almost anything with a value that goes up and down. It could be a share of a company, right? Or the exchange rate between the US dollar and the Indian rupee. It could be the price of gold. Or, and this is where it gets interesting, it could even be something as random as the amount of snowfall at a ski resort. Seriously.
Okay, so let's dig into the main types of contracts you'll find. Now, there are a lot of complex ones out there, but almost all of them are built from these basic blocks.
First up, we've got forwards and futures. The easiest way to think about these is as a legally binding promise. Two people agree today on a price for something that they will exchange at a specific date in the future. The key word here is commitment. It's a done deal for both sides.
And then we have options. And just like the name says, an option gives the buyer, well, an option, a choice. It gives them the right, but, and this is crucial, not the obligation to buy or sell something at a price they've already agreed on. That flexibility is what makes them totally different from futures.
So let's make this perfectly clear, because this is the most important distinction. With forwards and futures, you are locked in. You have an obligation. You have to go through with it. With options, you pay a little bit of money for the privilege of choice. You have the right to do the deal, but you're not required to. Obligation versus right. That's the whole game.
Okay, so we know what derivatives are and the basic kinds, but who's actually using them and what for? Let's meet the 3 main types of players in this market.
So first, you've got the hedgers. Think of them as the protectors. They're using derivatives like an insurance policy to protect themselves from price swings they don't want. Then you've got speculators. These are the risk takers. They're using derivatives to place a bet on which way they think prices are going to go, hoping to score a profit. And finally, you have arbitrageurs. These are like the market detectives, always looking for tiny, super quick price differences between markets to lock in a small, almost risk-free profit. Let's zoom in on the 2 most common strategies, hedging and speculating. They're really 2 sides of the same coin, which is all about managing risk. One person is trying to get rid of it, and the other is trying to take it on. Let's walk through a classic hedging example. Imagine a company in the US needs to pay a British supplier £10 million in 3 months. What are they worried about? Well, their risk is that the pound might get stronger against the dollar, which would make their payment a lot more expensive. So to get rid of that risk, they use a forward contract to lock in an exchange rate right now. So no matter what the currency does over the next 3 months, their cost is fixed. They've given up the chance of a better rate, sure, but in exchange, they get certainty. The risk is gone. It's neutralized.
Now, let's look at the speculator's favorite tool, leverage. In this example, you could take $2,000 and buy a stock directly. If the price goes up, maybe you make a $700 profit. Not bad at all. But what if you use that same $2,000 to buy options instead? That same price movement in the stock could earn you a $7,000 profit. That's a 10-fold return. It's an incredible power. But remember, leverage is a double-edged sword. If that stock price had gone down, your stock investment might only lose a bit of its value. But that options contract, it could expire worthless. You could lose your entire $2,000 investment. The gains get amplified, but so do the losses. So this ability to both manage risk and to amplify it through leverage is exactly what makes derivatives so powerful. They are incredibly useful tools for the global economy, but that same power, when it's misused or not understood, can be incredibly dangerous.
This quote from the former CEO of Lehman Brothers kind of captures the aggressive culture that can build up.
When you combine that mindset with the massive leverage that derivatives offer, and you don't have proper oversight, well, the results can be catastrophic. We all saw this play out during the 2008 global financial crisis, where some of these complex derivatives were right at the heart of the meltdown. It's a pretty stark reminder of their potential danger.
And that leaves us with a final, really crucial question to think about. These powerful tools are designed to shift risk from someone who doesn't want it to someone who's willing to take it on. But does that transfer actually make the risk disappear? Or does it just move it around the financial system, sometimes hiding it in places we can't see, until it's too late?
I really hope this breakdown has helped clear up the world of derivatives for you. If you appreciate this style of clear, simple financial education and you want to keep building your knowledge, please go ahead and subscribe to Trading to Rise. Thank you so much for joining me today.